What is riba? Why is it prohibited in Islam? And how does Islamic finance work without it? To answer these questions, this short video will cover 4 points. Number 1. Types of riba. Islamic scholars identify 2 main forms of riba. Riba al-nasiya, which is usury in loans. When a lender charges a borrower interest for extending a loan or delaying repayment. For example, if a borrower takes $1,000 with a promise to return $1,100 after a year, the extra $100 is considered riba. The Quran directly condemns this practice. O you who have believed, do not consume usury, doubled and multiply, but fear Allah that you may be successful. Quran 3-130. The second type is riba al-fadl, which is excess in trade. This involves an unequal exchange of similar commodities, such as exchanging 1 kilogram of gold for 1.2 kilograms of gold. This trade is prohibited because it introduces exploitation and an unfair advantage. A hadith by Prophet Muhammad, peace and blessings be upon him, states, "Gold for gold, silver for silver, wheat for wheat, barley for barley, dates for dates, and salt for salt, like for like, equal for equal, and hand to hand. If these kinds differ, then sell however you like, provided that it is hand to hand." Number 2. Why is riba prohibited? Islam prohibits riba due to its detrimental effects on individuals and society. Charging interest, especially high interest, burdens borrowers, often exacerbating wealth inequality and concentrating wealth in the hands of lenders. Furthermore, riba encourages a risk-free profit, which can lead to the growth of unproductive activities and wealth accumulation without contributing to economic growth or social good. As such, riba-based debt often leads to unsustainable financial systems, making economies vulnerable to crises like the 2008 global financial meltdown. Number 3. How Islamic finance avoids riba. Islamic finance replaces interest-based transactions with ethical alternatives. One method is murabaha, which is cost-plus financing. Instead of providing a loan, an Islamic bank purchases an asset and sells to the customer at a marked-up price, which is agreed upon upfront. For example, a bank buys machinery worth $10,000 and sells it to a business for $12,000 to be paid in installments. Another method is mudaraba, which is a profit-sharing partnership. One party contributes capital and the other expertise. The profits are shared according to an agreed-upon ratio, and the loss is borne by the capital provider unless negligence is proven. Additionally, ijara, which is leasing, a financier leases out an asset or equipment to a customer for a specified period. The customer pays rent to the financier, who retains ownership of the asset. Number 4. Real-world implications. Prohibiting riba has significant real-world implications. It ensures that the benefits of economic activity are distributed fairly among all stakeholders. Funds are directed towards productive and socially beneficial activities, and speculation and harmful industries are avoided. Moreover, riba-free microfinance initiatives empower underprivileged communities by providing access to capital without the burden of exploitative interest rates. In conclusion, the prohibition of riba, Islamic finance promotes a financial system based on justice, fairness, and mutual benefit. By prioritizing ethical considerations over profit maximization, Islamic finance aims to create a more inclusive and stable global financial ecosystem. Thank you for watching this video about Islamic finance and investment. If you found it informative, please like and share it with others. Also, don't forget to subscribe for more informative content.